Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some more Ask James questions of the day. First question is from William. He says, I've heard that interest rates have crept back up, so shouldn't that affect CD rates favorably? All right, well, let's see, William. It really depends upon which interest rates, right? And again, what's happened recently is short-term rates have come down just a little bit, and long-term rates have actually come up. And the long-term rates have come up because of concerns about inflation. Now, whether it's tariff-based or otherwise, maybe they've come up because of market demands, on the long side, because, hey, if we fix this, now that's beyond this discussion today as to why it works this way. But, we have this trade deficit. Well, trade deficit usually helps keep our rates low because the money that's leaving the country comes back in and gets invested in things like government bonds. Well, now if we fix the trade deficit, that money is going to not be back on our government bonds, which means yields went up in long-term bonds. But most bank CDs are based upon short-term interest rates. Banks don't like to commit to a 10-year CD rate. That's, at least a 10-year rate that's competitive, right? Even though the 10-year government bond yield right now is decent, it's in the mid-4s, banks don't like to do that. So they typically get, better rates on the short-term side, right? But with everybody now more concerned about recession, the fact is that the Fed might lower rates as opposed to increasing rates. And if that happens, CD rates are going to continue to come down. Now, for retirees and those approaching retirement who are looking for income, this creates an interesting dilemma. CDs do offer safety, FDIC insurance. They may not be the most effective income generating tool in your retirement toolbox right now. You might want to consider a more diversified approach to creating income streams. Things like high quality dividend stocks, preferred securities, even certain types of bond ladders might provide better income opportunities with reasonable risk levels. Remember that as you're planning for retirement, you're not just planning for next year. You're planning for 20, 30 years of income needs. That means you need strategies that can adapt to changing interest rate environments over time, not just what looks good today. So William, I don't think that you're going to see any real positive bounce in the CD rates off of this. I'd be shocked if that would happen. If anything, you might see them to continue to trend downward. So if you need to buy a CD because it makes sense for your goals, then waiting probably isn't the best thing. You're probably better off just locking in and doing the best you can today. Great question. Thanks so much. If you would like to send in your question, you can do so by emailing them to poolelocke@poolelocke.com. Moving on to our second question. This email is from Arnold, and he says, you talk about disintermediation and how we can go directly to purchase these different investments. But how does someone do that? How does someone invest in these types of bonds and bond-like instruments without working with an advisor? That is a great question. And the answer is you may actually want to work with an advisor with this, right? Because if you haven't done this before, you may not want to try this at home for the first time. So I don't think working with an advisor is the worst idea. But let's go to the bank, right? You go put your money in a CD and they lend it out. Where do they lend it? They lend it out to people who want mortgages to buy homes. They want to buy cars, right? They lend it out to individuals. Now, if you're with a huge bank, let's say you're with, Goldman Sachs. Now, they don't do retail, but if Goldman Sachs might lend money out to corporations, right? They might lend money out to other businesses. And, you have to say, well, okay, why can't I do that, right? As a consumer. Lending out to businesses is usually more secure than lending out to individuals that want to just, buy cars and homes, right? Just think about it. If you have a recession, what's the first thing companies do when there's a recession? They lay people off because they want to continue to pay their debt and not default. So, that means here the person who bought the car and took a car loan, bought a house, got a mortgage, they could default on their debt, and that can affect the bank. But the bigger firms that have invested in corporations and lent money to corporations, they're going to still get paid their interest payments unless things get so bad that these companies have to, skinny their business down so far that they just can't pay their debt anymore. So when you think about this, how do we do this? Well, in the world, we buy bonds, right? When we buy a corporate bond, that's exactly what you're doing. You're lending money to a corporation. You're doing what only the biggest banks might do. Often the banks that don't have very competitive CD rates at all. Now, for retirees specifically, this approach is to generating income. It can be extremely valuable. When you're living off your investments, having predictable income streams becomes crucial. Corporate bonds, especially those from established companies with strong balance sheets, that can provide the steady income that helps you sleep at night during retirement. You can actually purchase individual corporate bonds through most major brokerage platforms. Fidelity, Schwab, TD, Ameritrade. They typically have bond search tools where you can filter by credit rating, maturity date, yield, and other factors. If you're not comfortable selecting individual bonds, there's also bond ETFs and mutual funds that focus on income generation while providing diversification across many different bond issues. So why not skip the intermediary? Invest in something safer than your bank is probably going to invest in, because you're not investing in individuals buying cars or homes. You're investing in large companies. And frankly, for them to default on that debt, the stock in those companies would have to go to zero value before they default. And you probably already own mutual funds or ETFs on, or things in your 401k where you already have stock in these funds, for a lot of these companies. But the question is, why not just make a loan to these companies, right? Take out the middleman and be in an even safer spot with a consistent income, more so than the stock you currently own. Remember though, as you approach retirement, it's often wise to create a ladder of bonds with different maturity dates. This strategy gives you access to cash at regular intervals while still earning those higher yields compared to what banks typically offer. Thanks for your awesome questions. If you would like to send in your question, you can do so. You can do so by emailing them to poollocke@poollocke.com. If you like what you heard, go ahead, like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.